Hello everyone, welcome back. I got some really good ones for you today on this Tuesday, May 2nd, 2023. A lot's been going on with the markets, so let's dive right into it, shall we? The three major US stock indices, the Dow Jones, S&P 500, and NASDAQ, all pulled it back about 1% today, but nothing crazy. A little bit of selling pressure going into this Federal Reserve interest rate hike we have tomorrow, but we'll discuss that more. We have crude oil getting clobbered pretty good today. WTI crude down to about 71.54 a barrel. Never would have thought it would have gotten that low given the backdrop of sticky inflation and high core inflation, but hey, down in the gutter to 71.54. Large cap oil stocks also kind of following oil lower. Precious metals putting on a nice gain today. Gold about 2% gain, silver about a 2% gain, platinum up as well. So the precious metal space doing well. Crypto, Bitcoin stuck, we'll call it between 25,000 and 30,000 right now. Ethereum, we'll call it 1750 to 2100. So crypto's kind of looking around at these other markets, wondering which way to go. 10-year yield hanging out at 3.43% last time I checked. So it's quite stable and quite low. Low and stable yields. A dollar that's down about 0.25% today. Hey, that should be bullish for markets, but we have a little bit of selling pressure in the stock market. Precious metals are fine, but a little bit of selling pressure for the stock market and oil as we enter this conclusion of the FOMC meeting tomorrow and get a 25 basis point hike. There's a small percent of market participants that do not believe the Fed is going to raise rates tomorrow, but I think the Fed is going to. I think the Fed is about to raise interest rates 0.25% tomorrow, deliver, in my opinion, on what's already baked into the market's expectations. So they have nothing to lose by delivering on rate hike expectations that are already baked in. And if you're thinking, no, they can't hike rates tomorrow because they have the backdrop of this like weird banking crisis, well, fortunate for them, they've already had JP Jamie Dimon, the B system, they swoop in, kind of plug the hole with fake money with the help of the FDIC and Fed in order to essentially bid on First Republic Bank. So as JP Morgan absorbs First Republic Bank and as the big four banks, kind of continue this consolidation of the banking sector, ultimately that's stimulative for the markets, in my opinion, and kind of like a hidden QE, kind of like a rate cut without having to do a rate cut. So while they're doing this, on the one hand, they can get away with raising rates tomorrow, especially because, in my opinion, the market has already, baked it in, and market's probably not going to freak out tomorrow if the Federal Reserve raises interest rates. If anything, I think tomorrow markets are going to go up. The NASDAQ, oil, Bitcoin, and gold, I think tomorrow I'm forecasting are going to go up once the Fed delivers on this 25 basis point hike. And then these forward-looking markets are saying there's no more rate hikes coming, so that's a huge relief. And the market's already pricing in like a 60% chance of rate cuts later this year, which ultimately will be, in my opinion, rocket fuel for risk assets like the NASDAQ, oil, Bitcoin, and gold. Rocket fuel for residential real estate as mortgage rates come down and borrowing costs remain well below the inflation rate, allowing in real terms, real estate price tags to continue inflating. And you're seeing that, you're going to be reading articles, demand for residential real estate is higher than anticipated this season. That's what's making real estate go up. Not really. It's mortgage rates remaining below the inflation rate, and then a market that's ultimately pricing in the Fed cutting rates. And once the Fed cuts the benchmark interest rate, mortgage rates tend to follow. So if anything, the market's starting to price in like no interest rate hikes and maybe even cuts. And this is all very bullish for risk assets, bullish for inflation, bearish for the dollar, bearish for savings, fixed income, CDs, wage earners, who continue to be decimated by inflation, entrepreneurs who continue to have their margins blown out by inflation. It's funny too, as these entrepreneurs try to raise their prices to restore their pre-pandemic margins and, price in all this inflation, you have like chief economists like at the Bank of England saying, no, you just need to accept being poor now. We're going to inflate our banking system, our B system, but you shouldn't be raising your prices along with core inflation and overall rising CPI. You need to stay put and just eat the inflation. I find that so funny. So go ahead and Google Chief Economist Bank of England telling people to accept being poor. Classic rhetoric from the beast system. Well, actually, normally they're just lying to you about inflation and just lying. But he's just saying, no, just accept it, which is like a whole new low. You know, if I didn't laugh, I'd cry. I guess you could say it's ridiculous, right? But hey, that's actually the status quo. You know, we talk a lot about the they and the base system. So there you go. It's doing what you'd expect it to do, you know. So ultimately, I think, yes, 25 basis point hike to the Fed funds rate tomorrow, followed up by dovish rhetoric from Powell in the press conference. And that's actually going to push NASDAQ, oil, Bitcoin, gold higher because now there's no more interest rate hikes. The markets, if anything, are pricing in rate cuts, even though the Fed hasn't telegraphed that at all. So that's interesting. It's interesting how 60% of the equity market is like, there's Fed cuts coming later this year, but the Fed hasn't even announced that yet. It's like, is the tail wagging the dog or the dog wagging the tail? Or like, it's really interesting. Does the market know something that the Fed doesn't, or does the market know the Fed knows they're kind of bluffing right now and ultimately will cut rates? Or is the market just being hyper bullish all the time and just being like, of course there's a rate cut coming? Because that's like what allows me to inflate by any and all, by any means necessary, right? So it's interesting, there's like the poker game going on, right? But the Fed's not gonna hold rates steady tomorrow. They're gonna rise, they're gonna hike rates 25 basis points. And the market's gonna be like, okay, cool, and then probably like that, especially if Powell's rhetoric is dovish, which ultimately I believe it's going to be. And especially if the market doesn't see any more interest rate hikes coming after tomorrow. So if you're reading articles right now that are like, the Fed's raising rates tomorrow, what you need to know. And then they say things like, this is good for savers, this is good for fixed income, this is good for CDs. No, it's not. Because tomorrow marks peak hawkishness. And from here on out, it's like steady rates are lower. And that's ultimately bad for the dollar, bad for fixed income, good for inflation, good for risk assets. You see what I'm saying? So, it's crazy. We also have the debt ceiling drama, but guys, when it comes to the debt ceiling and the debt-based monetary system, it's not really red versus blue issue and a political issue. It's a green issue, if you catch my drift. That debt ceiling is going to be raised, no questions asked. The more conservatives might use it kind of as a bargaining chip, like, look, we'll allow the debt ceiling to go up because we don't want that, pretend to not want that, right? Because they're all big government pro-deficit. But they might say something like, no, Biden has to agree to some level of government spending cuts in order for us to agree to raise the debt ceiling. So some sort of negotiations like that might happen, but ultimately the market doesn't care. The market only cares that the debt ceiling continues to go up, that the B system continues to feed, that the equity markets will continue to meet their embedded growth obligation of like 6 to 12% per year, 8 out of 10 years. The markets just want to see the debt ceiling raised, and ultimately politicians are not going to stand their ground and commit to austerity. So like cuts to government spending, like they're not going to tighten their belts. Everyone knows this. It doesn't really matter. It's a non-issue. It's not about red. It's not about blue. It's about green. And the debt ceiling is going to get raised. And we're just going to find any and every excuse to print more and more in perpetuity, regardless of what happens. So your debt ceiling's going up. I wouldn't get too freaked out about that at all. And then I wouldn't really get too freaked out about this tightening labor market. We had call it 12 million job openings a few months ago. Now it's only 9 million. Really, to me, that's just entrepreneurs realizing they can't fill a lot of these roles for really low, unlivable wages. And they realize that the inflation is not transitory. So they're just kind of throwing in the towel on instead of maybe hiring 20 people, they're going to hire 10, but allow those 10 people's wage to actually keep up with inflation. And then they're going to fill the gap in productivity with like automation and AI, which are already trends you're seeing. So it's not really anything I'm freaking out about. Like, I don't think the labor market is, imploding, or I don't see like mass layoffs coming that the market hasn't already baked in. Now, there have been layoffs going on. Tech has dropped a lot of people, but the market has pretty well baked all those in when those tech companies lost 50% of their value, last year when the tech bubble ultimately imploded. So layoffs are not a leading indicator, they're a lagging indicator generally. So meaning if we get a bunch of layoffs tomorrow, that doesn't precede a stock market crash and then a reaction from the beast system. It's the opposite. The stock market always tends to crash first, the recession hits first, and then the layoffs happen. So these layoffs that we're getting through right now, really, to me, that's more the back end of the recession, and we're moving into a new business cycle without having moved into a new credit cycle. We're just going to keep the beast system solvent and inflate at all costs. So I don't think interest rates are going to continue higher. I think markets have pretty well cried uncle with regard to letting interest rates rise. They're not going to let them break the back of inflation. That's going to keep inflation high. It's going to keep the dollar weak. It's going to keep wages stagnating and essentially collapsing in real terms. And it's going to keep the beast system, the equity markets, moving up, the real estate markets moving up 6 to 12% per year, 8 out of 10 years, regardless. So, a bit of a recession of affordability. And a lot of mixed messages from the financial sphere and from the real economy, and the mismatch there, and that gap actually like widening, even though that's super frustrating. That's kind of what you got going on right now. So just kind of my framework. So the debt ceiling doesn't really freak me out. What's going on in the job market doesn't really freak me out. That's really entrepreneurs just trimming the fat, maybe willing to forego higher gross revenue, but make their margins sweeter and better, and then work less hours, something like that. A little bit more self-employed type behavior out of people too, that just cannot and will not work for, $17 an hour. So not with $500,000 houses, $50,000 cars, $30,000 Bitcoin. Like, get real, $350 groceries, like $85 to fill the gas tank. Like, it's wages are going to need to keep up, and if they can't, then we're just going to have to fill that gap with automation and AI as entrepreneurs, and go with fewer employees and pay the ones we can as well as we can, given the monetary energy is being sucked out of the economy via inflation. So everyone's working harder and harder for a currency that's falling faster and faster, or running on a treadmill while the oxygen is getting like sucked out of the room, as Michael Saylor, puts it. So crazy stuff going on, but I mean, whatever. Fed will deliver tomorrow their interest rate hike. We do have another thing I want you to pay attention to. Stock buybacks are getting pretty weird and out of control. So Google, Meta, share buybacks, stock buybacks, April 2023, do the same thing for Microsoft, Nvidia. Start looking around at some of these mega cap tech companies that are engaging in a form of financial engineering called stock buyback, where they borrow money cheaply from like a commercial bank, and then let's call it they borrow at a 4% rate. So they borrow, we'll call it $1 billion at a 4% rate. Then they turn around, they buy their own stock with that $1 billion. It juices the stock price 8%. They pay back the loan, and they keep the spread. Financial engineering, stock buybacks, as the beast system continues to feed, regardless of what happens with labor, regardless of what happens with inflation. So that's kind of what you're dealing with. It's crazy, but it kind of always is. So there you go. We're just going to keep going, stay positive. We're going to get through this rate hike tomorrow, hoping for dovish rhetoric, hoping that buoys and boosts those risk asset prices that we've talked about, as the market looks forward and says no more rate hikes. That's awesome. And maybe even rate cuts, which would be rocket fuel for things like the NASDAQ, oil, Bitcoin, gold, and real estate price tag. So one more thing, and then I'm going to let you go. One area that is problematic though, commercial real estate. So that's kind of the elephant in the room right now. We don't need all this commercial real estate, all right? So somebody's gonna end up holding the bag. But it might just so happen that most of this commercial real estate is being held by those smaller, more regional banks, and they're ultimately gonna get bought by the B system, by the big four, absorbed by them for pennies on the dollar so that they can consolidate power at the top and create that oligopoly of the banking sector. Kind of maybe like airlines is, you know, a club that you're not invited to, nor will you be allowed to enter. So that's crazy too. So just kind of pay attention to, you know, the weird wackadoo stuff going on. And we're just going to carry on, all right? We're going to be all right. And, you know, make sure your wage is keeping up with inflation. If you're an entrepreneur, you're selling products that are doing the inflation rate, and we're just going to inflate out of this, because that's ultimately what the B system is looking to do, in my opinion. Just my opinion. Could totally be wrong. Never a buy-sell recommendation on anything. You know, I'm not going to tell you what to do, nor will I, nor should I. Everyone's at a completely different place in their life's journey. So this is just kind of my framework, and I hope it's useful. If you could hit a like, that'd help me out. Subscribe, that'd be awesome. And we're just going to keep going, all right? Till next time.